Hi, everybody. Good morning. This is John Jagerson from Profiting with Forex, and I'm actually really excited to be here again with this doing this webinar with FX Street. So let me do a really quick introduction for those of you who have not met me before. I'm one of the co-authors of the book Profiting with Forex and one of the contributors to the site profitingwithforex.com or pfxglobal.com. So for those of you who have been there, you probably have heard my name before or my voice. And today's subject actually is long-term investing in the Forex. And this is one of my favorite subjects, and I find it actually quite exciting. So I think that, and I have, besides just talking in general about some of the advantages of long-term investing in the Forex versus short-term investing in the Forex, I have a couple of very specific strategies that I'll show you as well that I use in the long term. And before I jump in, let me just get an okay that everybody can hear me and you can see my slide presentation. Okay, you should be seeing a slide on your screen that says long-term investing in the Forex. Okay, great. So it sounds like we're doing all right. Let me talk for just a minute about Forex investing or about long-term investing in the Forex versus short-term investing, just to kind of set the stage. And I have to kind of preface this with I realize that short-term investing is a lot of fun. And when I say short-term investing, here's how I would define it. I would call short-term trading or short-term investing as anything between day trading versus kind of what we would traditionally think of as swing trading. So a position that may last a few days. And now I realize that we have, especially with this audience, we have a quite an extreme range of experience out there in the Forex. So I know some of you have been out there for years, and I know some of you might be a little bit new. But even with experienced investors, I've found that there's some common complaints. One of which is getting whipped around by the market. And in fact, the most common consequence of being whipped around by the market is that our stops get hit. Now, I've had conversations, or I've done a couple of presentations here where we talk about how to use options to avoid that situation. But nonetheless, the issue still exists in that in the short term, that random volatility in the market, and that's exactly what I mean is random. That random movement in the market tends to be much more of an issue because you're dealing with a couple of things. So number one, I don't know how many of you out there ever go to the casino and gamble or anything like that. I don't. I get more than my fill in the public markets. The analogy is very similar to roulette. And a roulette wheel has basically equal red and black spots. So if you were to put your bet on black, you would have an equal chance of getting black versus getting red. But there's a couple of green squares where those are basically the house squares. And in some roulette wheels, there's only one, and in some there's two. And basically what it does is that it puts the odds a little bit against you, against your favor. So what that means is that essentially, if you were to just go red or black, there is the possibility that you're going to get green and anyone would lose, whether they're red or black. So the house wins in that case. And in many ways, I consider short-term trading in the Forex dealing with a couple of green squares. And one of those would be the spread. We know that on a percentage basis, the spread makes dealing in the Forex actually quite expensive if you're working on the short term. We love the fact that there's no commissions and such, but that spread can actually be quite expensive. And that's one of the things that can put things a little bit against our favor. The other one is, of course, that random volatility. I would also say that one of the other difficulties in trading is that it's very difficult to manage more than one position or more than a few positions. When I'm going to get to this here in just a minute about the benefits of diversification, which before you turn your nose up at that or anything, it's actually very there's a lot of benefits from diversifying in the Forex, and I'll show you specifically some of the ways that I would employ that idea. But doing that on a short-term basis is tough because there's just so much information, and even small movements matter a lot. Which means that, of course, we have to spend a lot of time in front of our trading. Now, not everyone has the ability to monitor their Forex positions on a full-time basis, meaning that you're doing other things. Maybe you have another profession besides trading in the Forex. And that's where long-term trading can really come in and play, because you don't need to pay attention to it on on an all-day long basis. There are ways that we can help eliminate the risk that's associated, that we're trying to avoid by having to pay attention to a short-term trade that closely. And then finally, the last thing I would mention is that oftentimes we'll hear academics talk about markets like the foreign exchange as a zero-sum game, meaning that for every winner there's a loser. And in mathematically, that's correct, but we have to take a step back and really think about that problem as it relates to short-term trading versus long-term investing. On the short-term basis, that's in fact, I think, very true that it is a zero-sum game, and you have to be very talented. Now, it's certainly possible for a talented trader to outcompete all the other traders out there and to come out ahead on a short-term basis. But it is very difficult, and you're trading against a lot of very smart people. So, but on the long term, however, we can start to think about why do the markets exist? They serve a purpose besides just an opportunity for speculators like myself or like yourself. In fact, most of the markets exist because there's a couple of underlying business needs, one of which is they need to be able to raise capital. They need access to capital. So the stock exchange would be a perfect example of that, where a business needs to raise capital. The second one is there's a need to diversify risk. So they want to spread out their risk amongst a much larger base of shareholders or investors, depending on which market you're talking about. And the question really is, well, okay, so if two of the underlying principles in a market, and the Forex is a great example of this, is the need to raise capital or have access to capital, and the need to diversify risk or hedge risk, then as a speculator, I can step in and take advantage of that, so that I'm basically working with the underlying principles behind the market, the whys behind why longer-term investors, or why most of the investors in that market exist, and why are they doing what they do, where those forces are not as easy to see or to use on the short-term basis, if not impossible on the short-term basis. So let's jump into let's get into a little bit more detail here. So when we're talking about long-term investing, we're really talking about two basic priorities. The first one is diversification. And recently, I hate to quote this guy, and I don't know if you know who this is, but depending on whether you're in the U.S. or not, Jim Cramer, I never watch him. He's a stock analyst in the U.S., and he's very popular as a TV show, and he writes a lot. And he's a bit of a wild man, but he was a very, very successful hedge fund manager who was not only invested in equities, but did a lot of work in Forex and futures, etc. And so I got to attribute this quote to him, that the only free lunch you'll get from the market is diversification. And there's a reason for that I'm going to get to here in just a minute. But the idea is, behind diversification, is that we're trying to spread our risk out amongst more than just a single investment. So it can be very tempting for us to say, well, gee, the pound yen is on the move. I have a $20,000 account. Let's throw $10,000 worth of margin onto that trade. And of course, the problem with that is that then we're concentrating our risk. And the immediate comeback that a lot of people will say is, well, if I have a $20,000 account and I see that the pound yen is on the move, well, I'm not going to throw $10,000 of margin on it. I'll just throw $1,000 of margin on it, which is much more reasonable. Maybe I'll take a single contract out. But the problem is really the same in that if that's the only position, it can be very tiring from an emotional perspective to have to withstand the ups and downs of the pound yen, and it can really mess with you. So diversification is one way that we can smooth the equity curve. And when I say equity curve, what I'm really referring to is the growth in your own account. So the second priority that we deal with are economic fundamentals. Now, when I say economic fundamentals, I am referring to things like GDP, and I actually have a GDP trading system, if you can believe that, and I'll show it to you today. And it's very specific and it's very easy to implement, and it works quite well. But I'm also referring to things like yield. So one of the examples that I'll show you today is how we can use the difference in stock market yields from one economy to another. So if we were comparing a large European stock index versus the U.S. stock index, or the U.S. stock index versus a large Japanese stock index. And Forex traders will be pushed around by yield, and not just interest rate yields, but other things like stock market yields, equity yields. And largely that's because they're very related, but it's one of the other systems that I'll show you. It's very easy to implement and has played out quite well in the past. So those are the kinds of things that I'm looking at when I talk about economic fundamentals. So let's get into diversification a little bit, because this one is a really important concept. The first concept I want to talk about just for a minute is the difference between correlated Forex pairs, inversely correlated Forex pairs, and uncorrelated Forex pairs. The obviously correlated Forex pairs, like I picked two this is obvious, the Euro US dollar and the pound dollar. They're going to move in essentially the same direction over, even in the short term versus the long term. They look very much the same because, of course, the dollar is the quoted pair, or is the quoted currency in the pair, and they're going to be subject to basically the same kinds of things. And the two economies between the Eurozone and in the UK are actually quite related. So they tend to move up and down at the same time. And therefore, investing in both of them is a little bit like investing in one trade. Inverse correlation, by contrast, so if you look at, for example, the Euro US dollar and the pound dollar, well, if we were to compare the dollar franc and the dollar yen to those things, they'll tend to move exactly the opposite, which is inverse correlation. So what I'll find is that a lot of folks will want to stay with, these are probably the four most popular majors. And I'll talk to a lot of traders who had a few trades go bad on them at the same time. And you'll find this as a symptom that they had a lot of correlated trades on at the same time. Probably one of the best examples that I've seen causing traders problems here recently has been carry trade issues. So they will have a quote-unquote carry trade portfolio that's been diversified across, say, the Aussie yen, the Kiwi yen, the pound yen, the Canadian yen. You get the idea. As they've got the yen on the other side of all those trades, so they're very correlated with each other. And when you're trying to be diversified, you're looking for uncorrelated assets, assets that aren't going to move the same direction all the time. Because here's what you're trying to do. As we get down to this last bullet point here, what we're trying to do is to adjust our risk. There's really two kinds of risk in the market. There's systematic, and then there's unsystematic risk. And systematic risk, that's just the nature. That's risk. You can't really do anything about it. It's just the risk of loss in the market in general. It is possible for everything just to go crazy all at the same time, and it's why, as a speculator, you can expect a premium on your investing is because you're willing to take some of that systematic risk out of the market and absorb it yourself. However, the second one is unsystematic risk. Now, this is the risk that's associated with a specific currency pair. So, for example, the euro US dollar, the risk of the euro US dollar suddenly falling apart on Tuesday when we hear from Trichet is unsystematic risk. And unsystematic risk, if you look at these as two pieces of the same pie, you can eliminate unsystematic risk through diversification, which means that if you're spreading your risk across a large number of pairs, then the downfall in one is likely to be offset with a gain in another, and so you get a much smoother equity curve. In fact, I've been asked before, so I've done a lot of work in not only the foreign exchange, but in all the public markets. And one of the things that I've done in the past is to create indexes. And the beauty behind indexes is that the reason why they work so well and you're able to be so hands off is that they don't require stop losses. And the reason why is that a stop loss is a tool that we use to manage unsystematic risk. That's the risk, again, associated with a single currency pair. If you're just trading the euro US dollar long, well, then you definitely want to put a stop underneath the market in case it begins to fall down. But if you've diversified out that unsystematic risk, then you don't generally use stop losses because you're really taking a much longer term view and you're diversifying out that unsystematic risk, which is a major difference between what's going on when you're very short-term trading a single pair. So it's the difference, I think, between trader myopia or having tunnel vision and just looking at a single position versus when you're looking at a portfolio or you're managing a strategy rather than a single position. So let me show you a couple of examples of exactly what I mean. We're going to be looking at basically four different ideas here, all of which I'm going to try to make sure that I go into enough detail to show you exactly how I would implement this in how would I index or create an index using these four strategies. And I'm going to be looking at the carry trade, which is a popular strategy we're all familiar with. And I hope to show you something a little bit new here that you'll find interesting. We're going to be looking at a system that I use using GDP, which really focuses on developing economies and growing economies, as well as established ones. And I'll show you that here in a second. It's one that I've hinted at before. And we're going to spend a little time expanding on the system that I mentioned where we look at yields. And specifically, I'm going to be looking at market yields. And then finally, institutional momentum. So I'm going to be taking a peek at the Commitment of Traders report. Most of you probably know what that is. And if you don't, then this will be an interesting introduction for you. But it's a way that we can kind of look and see what are institutional traders doing, because they tend to be slower moving and kind of they're very good at predicting some of the underlying biases in the market. And so there's a way we can take advantage of that. But the underlying principle being that we're going to be talking about how can we make sure that we're employing a strategy that can be deployed across a large number of currency pairs. All right, so let's switch gears here a little bit, and I'm going to go to my charts. And if I could get a confirmation that you can see my charts, I would appreciate it. Okay, would you let me know if you can see it now? You should see 4 charts. Chart's okay now, okay. I guess you were looking at the list of attendees. Sorry about that. Okay, so I've got basically 4 charts up here. And what I'm trying to do is to illustrate one of my points is that this is, of course, what I would say is a typical carry trade portfolio from those who have been struggling the last little while. So we've got the Kiwi yen, the pound yen, the euro yen, the Canadian dollar. So obviously very correlated. Let me change gears here just a little bit, and I'm going to introduce you to another idea. Let's see. Okay, what I'm doing here is I've just opened up 6 charts. And you can probably see the labels on each of these charts. They're all we've got dollar crosses in here, and there's 6 different currencies. And this is also a version of the carry trade, but in this case, what I've done is I've replicated, without using crosses like the pound yen and such, I've replicated a strategy out there called the Currency Harvest Fund. And I don't know how many of you have ever heard of that, but it's a very interesting investment strategy that's been employed for quite a while, actually. So this is a institutional strategy where they're doing the same thing. They're using a carry trade, but what they did is they looked at the G10. Now the G10 includes currencies like the well, obviously the pound, the Swiss franc, the Swedish kroner, on down the list. And what they looked at was they said, okay, out of these 10 economies, what are the top 3 interest rates? Let's go long those currencies. So we're long those currencies versus the dollar. That would mean that we're long the New Zealand, the Aussie, and the pound. So we're long those three currencies. And we're going to go short those 3 out of the G10 that offer the lowest interest rate, which in this case would be, right now, that would be the yen, the franc, and the Swedish kroner. So the idea is that we're getting a lot more diversification because we really only have one pair here that's crossed with the yen. We only have one that's crossed with the franc, on down the list. So what we've done is we've diversified out a lot of the risk that we've been experiencing on the yen, because we've only invested a very small portion of our portfolio in it rather than a much larger percentage of our portfolio on it. Now, here's where we get down to the real meat of it is we can easily say, okay, so how does this play out into dollars and cents? Because, the real advantage behind, for example, the pound yen or another is that when they move big. So there's some big gains here to, are we avoiding a lot of the big gains? And by the way, this strategy that I'm showing you right now, this is easy to replicate, and there's a couple of advantages of doing it this way versus, let's say, investing in the fund itself, which I'll tell you what the symbol is in case you're interested. But the advantage here is that if you had invested in if you compared this strategy here, fairly diversified, versus just the pound yen, so probably one of the most popular carry trade pairs out there, from the start of the year 2007, you would still be up 6% on an unleveraged basis. So this is unleveraged. You'd still be up 6% versus the pound yen. You would actually be even. You'd be at a break-even point. You'd be 0%. So over time, that we use the same concepts that were working so well with the carry trade, but we diversified out a lot of that unsystematic risk associated with the yen, for example, where we saw this big adjustment on the yen here recently, which knocked down the pound yen into a position where it was more in a break-even situation. And of course, with the correction, as you would imagine, with the recent correction we've had across the carry trade, the losses have been less versus this kind of diversified portfolio versus, if you were to take the Aussie yen or the Kiwi yen, both of whom have accumulated many more losses than the diversified strategy has. So now the advantage, of course, of being individual investors like us versus just relying on the institution to apply this strategy for you. And by the way, if you were interested in comparing yourself to an institution who does do this exact strategy, so you can kind of see, well, how am I performing versus them? The symbol is DBV. I'm going to type that in here. So the symbol is DBV, and you can look at that, and it's a publicly traded ETF. You can see exactly how are they performing. The advantages that you have, of course, is that you don't charge yourself fees. whereas they do, and you're much more flexible, and you have the ability to leverage your portfolio. So I know a lot of us have a great deal of tolerance for risk, and would be willing to leverage our portfolio quite a bit more, maybe 2 to 1, 3 to 1, even 4 to 1 or more. And likewise, our upside and downside are going to be much larger than an institution would do, and ultimately is probably going to work out for the best for us. The second thing is we all collect a higher percentage of that interest premium every day from our currency pairs. So that's another thing to keep in mind, is that less of that is passed through to you in an actively traded fund. So that's one way in which this strategy is used. Now here's where the long-term outlook comes into play. We don't play stops. We don't worry about jumping in and out or anything like that. About once every quarter, you go in and you reevaluate. And if one of the top 3 interest rate bearing currencies has dropped off the list, you pop it off and you put the next one up. So it's really something that you have to adjust very rarely, because you've taken that unsystematic risk off the table. When you really look at it, we've diversified ourselves quite effectively. Let's switch gears a little bit here. Let's go to another idea, and I'll show you exactly how I would implement this and how it's performed in the past. I'm going to open another layout. And I'm going to open one. I'm going to open 4 currency pairs, actually. There's one that's missing here that I'm going to add on that I think would be useful for us to have a short discussion about, because it's one that recently had to adjust. Okay, so we have 4 currency pairs here. And this is a strategy, I call it my GDP strategy. And what I'm looking at is that I'm looking at the underlying fundamentals of currencies, and I say, all right, well, when GDP growth rates are very high, what happens to that underlying currency? What tends to happen to that currency? Well, it tends to rise, because growth increases yields and demand, etc. And so it works out to be a pretty effective strategy to look for currencies that are offering or that are exhibiting a very high GDP growth rate. And in this case, actually, the growth rate that I look for is 4% or greater. So I look across the currencies that are available to a retail trader to trade, and I identify all those currencies that that currently are showing GDP growth rates of 4% or better. And I'll go long those currencies against the dollar. So, I'm using the dollar, by the way, only to provide a common denominator. It's more or less a neutral portion of this strategy. So the idea being, of course, is that I could modify this strategy to include crosses, and I could cross currencies that have very low levels of GDP growth rates versus those who have very high. But I haven't had as good a result. So this may be something you want to experiment with yourself. So as you can see, over the last year, if I was short these currency pairs outside of the dollar versus the Hong Kong dollar, I would have done pretty well. In fact, actually, so far this year, on an unleveraged basis, it would have returned about 4%. Now that doesn't sound like a lot, but if you look over time, so I've back tested this over as well as invested in it for quite a while, and you could expect on an unleveraged basis to be around 11%. Which again, from the Forex trader's perspective or Forex investor's perspective, we have the advantage of leverage and things like that we can use to adjust. Well, okay, how much risk am I willing to take versus how much reward do I really want to see? And so that 11% can be something different than that, obviously, as you're managing your leverage and your risk. But as you can see, what I'm really taking advantage of over the last year, even on the Hong Kong dollars, we look at the start of the year over here to where we are right now. All I'm really taking advantage of is this underlying pressure of demand for that currency. And in fact, when we look at the U.S. dollar versus the Hungarian forint, the reason why I brought this one up is that it dropped off the list in April. So I was off that particular currency in April when I got that report. And now, how often those reports come out? About quarterly. So it's something that I'm evaluating on a not very frequent basis. It's one more strategy that I've mixed into my overall portfolio that I only have to monitor every now and then when I get a new GDP report. I'm diversifying out a lot of my unsystematic risks, so I don't have to worry about a lot of stop losses and being whipped around. And these are very, very uncorrelated assets. So the what's going on the Hong Kong dollar or the Czech koruna or the Polish zloty and the Hungarian forint are very different, and so they're not going to be moving at all the time at the same pace in the same way. So sometimes they'll be a little correlated because they all have the dollar in them, but other times they're going to be very uncorrelated, and it helps to reduce that type of risk. Okay, so let's change gears here a little bit. I'm going to close this one. So this is one more strategy that I mentioned that I was going to show. I'm going to close this one, and I'm going to go to one of the strategies that I really like quite a bit. And this one is a little bit more active than the ones that I just showed a minute ago, but they certainly, I would not categorize them as falling in the even the swing trade category. I would say that since oftentimes their trades can last for several months, this is a whole nother strategy that really falls within the long-term category. And this is something that I call where I'm taking advantage of institutional momentum. So let me explain what I mean by that. There's a report out there called the Commitment of Traders Report. And if you haven't heard of that, let me give you a really quick definition of what it is. Basically, currencies are traded not only on the in the spot market, where we trade with dealers and such, but there's a futures market for it in the U.S. on the Chicago Mercantile Exchange. And a lot of the currency pairs that we're familiar with and in fact, most of them that we're familiar with out there in the spot market are also traded in the futures market. Well, commercial investors and institutional investors in the futures market report their trades, and you can see how many contracts are total that are outstanding, and how many are and how many are short versus how many are long. So you can kind of look and see, well, what are institutional investors who are trading on the futures exchange? What are they seeing on? What are they doing on a month-to-month basis? Are they overall, are they long, or overall are they short? Because overall, if they're long, like for example on the New Zealand dollar, well, then we should probably be trading that particular pair long, because the underlying pressure is going to be in favor of those institutional investors, because they represent a much larger portion of the market than, for example, retail traders like you and I do. So I'm going to go to now the Commitment of Traders Report. By the way, let me tell you how to get that. You can get that data from the CFTC. If you just Google the COT report, you'll be taken right to it. And the only problem is that it's delivered every Friday, and they don't really graph it or anything like that. We're all chartists. We love to see charts and see what's going on out there. And you can get graphs of it from other locations, but I'm going to go to my website and just show you an illustration of what I'm talking about. Now, I'm on my website. I want to make sure that let me stop sharing for just a second. Let me go to my website, and then I'm going to start sharing again. Okay, so you should be able to see my I'm going to zoom in on, you should be seeing a little chart that says dollar CAD, and it's got a orange and black line on it. It's kind of outlined in black. So if anybody can't see that, let me know. Now here's the idea. Basically, this baseline here, this represents neutral. Anytime this black line, these little dots, are up above that middle line, that baseline, that means that institutional investors are net long the dollar CAD. And anytime that they are down below this same baseline, that means that they are net short the dollar CAD. So the concept here is actually quite simple. When the institutional investors are net long the market, I'm using that as a fundamental factor that's telling me that, look, the underlying forces in the market are probably going to be pushing this to the downside, or to the upside. When they're long, I'm going to be looking at it, or when they're short, I'm going to be looking at it exactly the opposite. In that, the fundamental factors as well as institutional traders are going to be trying to push this to the downside. So we can use that information very effectively. Now, there's this. However, the problem is that institutional investors, they're slow. So you'll notice. I mean, they were long for a very long time, and they're short. They've been short for quite a while as well. So someone just asked the question: is this the difference between long and short for the commercial traders? We actually net the commercial hedgers out. So it's long or short, basically the institutional speculators versus the commercial traders. Okay, so the disadvantage with the COT report is that it takes a while for it to flip from a net long to a net short position, and so you get a lot of lag in there. Well, the change that we made is that we put on this little orange line here. It's basically a MACD of the of investing going in or out of the difference of that long or short position. So it's basically, here's the way you could look at it, is that we're trying to represent trader sentiment out there. Well, the idea behind this is that, so here's a really simple system, okay? And this is something that I would use on the long term. If I have this black line up above the baseline, so I know that overall institutional investors are net long, and I'm going to be watching this orange line. And when long-term investor sentiment decides to go negative, so they're beginning to they're not investing as quickly, then I'm going to exit my long position. Okay, so I was long when this went, the Commitment of Traders report went positive, and now I've exited that long position. Now, anytime the market goes back up above this level, or anytime that orange line goes back up above this base level, then I know that buying momentum is picking back up. So I'm going to get in, and then in this case, I got right back out again very quickly. Then you can see the same thing down here. When they go net short, I would go short the market as well, and I'm going to get out of that net short position when this institutional trader sentiment goes positive. So I've got someone asking this question: could I show this for the Euro US dollar? I definitely can. Let me just sneak a peek at that really quick, and then I'm going to go look at the charts, and I'll show you all how this played out in real life. So we have most of the major pairs here for and yes, you can do this exact same thing for the Euro US dollar. Okay, so keeping in mind, very simple system. I'm basically defining my bias by, well, what direction are the institutional traders playing? Well, if they're net long, then I'm only trading long positions, and I go long when their sentiment or when their buying is increasing, is on the rise, and I exit that long position when their buying is on the decline and goes down below that baseline. So a very easy idea. It's really not that dissimilar from a lot of the strategies that we've all used through the years on using technical indicators of all kinds, stochastics or whatever. Okay, I'm looking at, I just brought up my charts again, so if anybody can't see them, let me know. And I have, I'm going to illustrate my point with two pair, and then you can go check this out on your own, see what you think. And one of the principles that I would keep in mind is that the reason why we like the Commitment of Traders report is because it's available on so many different currency pairs. So, you asked Diane, you asked if it was available for the Euro US dollar, and it is, and it works the same way. So if we were looking at those same trades that we were just examining a minute ago, this is where they actually played out on the market. So we've got the dollar CAD here, and we would have been long in October of last year. We would have gotten out of that long position when trader sentiment began to drift in January. Then we would have gone short because trader sentiment had flipped. So trader sentiment had gone negative, I'm sorry, the Commitment of Traders report was showing net short positions by April, and then we would have covered that short position here in August. So you can see, I mean, there's certainly lag, but it will identify some pretty good opportunities. Let me show you another one that was a little bit more active. So the Kiwi was a lot more volatile. The Commitment of Traders report was traders were buying very quickly and then they were selling very quickly. So it was a lot more volatile than the Canadian dollar. So we were in and out a lot more. But for the last year, it's basically been net long. So the institutional traders has essentially been net long, and in a way they're a reflection of the underlying fundamentals that are going on out there in the market. So we're net long. As you can see, I've graphed these positions. So we go long in November, go short in January. And what I would encourage you to do, this is what I always like to do. Whenever I hear a new idea, I go back to the same data and I do the same analysis, just so I can get the idea myself. So don't just take my word for it. Go back and check it out for yourself. We would have gone net long, or we would have gone long again, based on, again, we're not going short because the institutional traders were always were net long. So we kind of buy into their sentiment, and then we get back out when their sentiment begins to drift. Their buying starts to dry off a little bit. And then long and short. So, or long and then covering with getting out of that long position. So the idea here is that just using one piece of information, we're applying some fundamentals to on a longer term basis, so that we're not in that kind of swing trade category, and we're looking for much larger upside, so hundreds of pips versus 10, 20, 30, or what have you on a more short term basis. So I just got a question about how do I reconcile that with one of the things that we do is we look at it kind of an overall, how strong or weak are all the currencies out there, just so we can get a view as to, well, how might we cross these currencies? It's really a different subject. So there are a lot of ways to look at the way that you're trading fundamentals, and this is merely one factor that I use to implement a strategy that I can diversify across a lot of different pairs. So if you want to have a longer conversation with that, since it's kind of a complicated subject to go into all at once, send me an email and let's chat about it, because we can go back and forth. I think it'll make a lot more sense to you. So I'm out of time right now, but if there's any questions before I end, let me go ahead and chat them in, and I'll get to them. A couple of things. My email address is john@pfxglobal.com. You are very welcome to communicate with me if you'd like a copy of the PowerPoint presentation. You're welcome to get that. We do record these presentations in partnership with FX Street, and I can tell you how to get that in a few days. So you can review exactly what we went over if you'd like to. And if you have any questions, such as the one that was just asked with how do I reconcile kind of the strategy that I'm showing versus the overall strength rating that we would put on a currency like that, I would be happy to go into a lot of detail with you. I love to talk to traders all day long. I learn things new all the time. So here's a question. Do you ever try to correlate the long or short in things such as gold with those in commodity currencies? Yes, I do. In fact, I did a presentation on FX Street just a little while ago on exactly how do I apply that on an intermarket basis. So, and you know, it's a great question. And in fact, this is somewhat related to the question I just got with, you know, how do I reconcile this strategy with another? In that it's okay to trade things that may give conflicting signals. That's really okay, because it adds to that diversification. The idea is try to have a longer term outlook when you're trading strategies that may have conflicting signals. That's not bad. What would be bad is trying to apply that on a short term basis. That would be tough. Applying it on a longer term basis allows me to apply a lot of diversification across my strategies as well. So yes, I would. Here's what I would ask you to do in your question on do I look at the commodities versus the commodity currencies, is to send me an email, and I can actually send you to a presentation that I go into a ton of more detail on that. But yes, I would look at that. I do look at what's going on in commodities when I'm trading those currencies we would consider the commodity currencies. So the last question is the yield strategy. I actually ran out of time before I got into that. Let me. I'm gonna put together a little bonus recording for that you can grab, Jack. So send me an email and I'll send that to you. It's essentially the same idea. Is that I look at what economy is what economy's equity index is outperforming another, and when that yield is higher in one, I'll go long that currency versus the one that's underperforming. So send me an email and I'll send you the detail on that. The URL for the COT charts, I assume you mean the ones that I was showing you. If you go to pfxglobal.com, so it's just pfxglobal.com, there's several links across the top menu, one of which is analysis. If you'll go to analysis, you'll find not only the yield charts that I would be looking at, but the COT charts and a lot of other extra information that we'd look at from a fundamental perspective. So if you click on analysis and then fundamental analysis, you'll find all that information. Well, thanks everybody. I really enjoyed my time with you, and I hope to be back very soon. You're a great audience, and I appreciate the time and attention that you gave me. Make sure that you send me an email if you've got any questions.